yay, yay. Hello, everybody, and welcome to today's No Income, No Problem webinar with Dave Oliverio. Let's get started. There's no CE. I love this so much, and you guys really are going to love it because even I'm considering one of these no income programs, and you'll see why. Dave always has such amazing programs. Dave Oliverio comes to us today with 30 plus years in the mortgage banking business and is currently the branch manager for New American Funding. As a top 1% originator in lending nationwide, he is not only experienced and respected as an expert in the field of real estate financing. Dave is really a great mind. I don't know if you guys understand what I mean when I say that, but he's really dives deep into what's best for the consumer. I've done 3 refinances with him. My oldest daughter's done 2, actually new home purchase loans. And I just don't know how he does it. I think he has a magic wand, but it's always better than you're going to expect. And I just really appreciate that. He seems to take care of everybody that way. As that's what I mean when I say he's a great mind in all the complexities of real estate loans and credit. He just pulls a lot of stuff off that he's an unsung hero. I think that's what it is for me. Dave is also one of the best loan up specialists that I've ever worked with. And I told you firsthand experience that I just went ahead and told you ahead of time. Dave is a valued instructor with Cindy Bishop Worldwide. Agents and consumers just love him. And well, which is true, obviously. He's in the top 1% of production nationwide for loan officers. So there you have it. Take it away, Dave.
Thank you, Cindy. Very, very kind words, and do appreciate it. And in general, yeah, I do dig in. Like, the way I look at it, the way I've always looked at it, I work for our borrower, of course, and I work for the real estate agent. Yeah, I see myself as an assistant practically, and then like, how can I make it better for our borrower and the realtors that I'm working with? So that's how I kind of view the role that I should be playing. But at any rate, this is like some interesting things are going on. This market about a week or so ago, it looked like we were ready to take off, meaning rates dropped way down. And then an indicator came out, like one indicator, it's called the ISM report, that was a little more inflationary than expected. So all last week, we lost ground. Like the week before, there was like a Thursday, Friday going gung-ho, like rates are gonna drop. And then the previous Monday, one indicator, actually was 3 indicators, came out. And then all last week, we lost some ground. Now, what's happening this week, the producer price index came out yesterday, was a little lower than anticipated. And then the consumer price index came out today as like what they forecast, how it came in was like right on the money. But the yesterday's was lower. So we got a nice little bounce back yesterday. So it does appear that we're heading in the right direction. It's really all about, through this data, the market anticipating what they believe the Federal Reserve is going to do with the overnight rates. It's all about anticipation. In my opinion, like the rates that we have at the moment, they're anticipating like very soon, mid-September, that the Fed is going to drop the rate, the overnight rates, by at least 0.5%. That's at least, I think that's already built in. But we'll see. It's a fickle market, it's a fragile market, and it is data driven. But the good news, we're in a heck of a lot better shape this week than we were 4 weeks ago or 3 weeks ago for interest rates, which obviously will help the market. So that's the good news. So, but at any rate, also, this is what else is going on, and it's been going on for a while, quite frankly. Especially once we finished with COVID, rates went up, low inventory, lenders have less business. So what happens when you have less business? You get more creative. That's not just our company, but across the board, because we're trying to figure out a way to bring in business. Quite frankly, that's really what it boils down to. But also, in doing that, it's also assisting the market, helping just not us, the lender, but helps our borrower, helps the realtor, because it can move the market, another avenue to move the market. So, so that's what we're going to talk about today. But so basically, we're going to look at truly an investor purchase without income documentation. So literally no income documentation for investor purchases. Very good program. Then what Cindy had mentioned earlier, it's called an asset depletion program, where you could literally, assuming that you have some savings in an account somewhere, or money market or CD or whatever, you literally could use your assets as income when qualifying. And then a bank statement program, essentially the bank statement program is for those self-employed individuals who are expensing the heck out of a 1040 or 1120S of corporate return, where they're showing very little to no income. So another avenue to scoot around the income issue for self-employed people. So that's what we'll discuss in this next about 45 minutes or so. Okay, this is a neat program, this program here. It's a couple reasons why it's good. One, the rates are not outrageous. So see, there are many programs over the years that lenders, including lenders that I've worked with, they'll come up with some creative programs, but then you can't price it, or the price is so egregious that it doesn't make sense for the borrower. Okay, great, it's creative and get somebody in, but is it in their best interest? And only the realtor and the borrower know that. So there have been creative programs over the years. This one fits the bill pretty nicely because it's also priced fairly well for an investor program. So combination, flexible and decent rates that we'll go over. But it's literally called, and I'm sure that some of you've already heard this, it's called Debt Service Coverage Ratio, DSCR. This is an investor no income program designed for investment property transactions that are designated for business purposes only. Okay, and there is a distinction, quite frankly, a distinction between this program and the Fannie Mae Freddie Mac investor programs, and I'll mention that distinction shortly. But designated for business purposes only. The qualification is literally based upon the cash flow from the subject property in relation to your mortgage payment. So that's what it's based on. So literally no income qualification. So that last sentence, borrower, employment, and income are not required. And therefore, there is no DTI, debt to income ratio, calculated. So you don't have to worry about debt. You don't have to worry about income. So then your question probably is, well, what do you have to worry about? Okay, let's get to that. Okay, so to be clear, it is for investor properties only. Loans must be for business purposes only. They want some reserves. In the scheme of things, 6 months in reserves in the scheme of things is doable for a lot of our borrowers, and I'm sure a lot of your requirements. Now, when they're looking at minimum This is unless you have 30, unless there is 30% down, the minimum DSCR, debt service coverage ratio, equals 1, okay, 0.80 with 70 LTV or less. That very simply, what that means is you buy a property and we do rental comps and or lease, most likely whichever is lease or less, excuse me. Let's say you rental comps, you get $4,000 on a rental comp per month. If your payments does not exceed $4,000, you're fine. So that's what's called a 1-to-1 ratio. So effectively, whatever the rental comes in, as long as your payments don't exceed that, everybody's happy. That's the 1-to-1 ratio. And that is with 20% down. You can do that with 20% down and get a good rate. So literally, you can put 20% down and get a good rate, 25% down, you get a more aggressive rate. But if you put 30% down, we'll use that same example, okay, your rental income is $4,000, okay? So basically, if your rental income is $4,000, you can make far less than that, 80% of that, in terms of, I'm sorry, let's make that clear. Let's say your housing payment is $4,000. So you have a housing payment of $4,000. That just means your rental comps only have to be $3,200. Take 80% of the $4,000. You have a rental payment. So it takes pressure when you put 30% down. It takes pressure on that 1-to-1 ratio. So if you put 30% down and you have a $4,000 PITI, you could have rental comps as low as $3,200 a month. So, that also could work. You do have to own a primary residence, and minimum is 12 months. So you cannot participate in this program unless you own a primary residence for 12 months, which, and most people that are looking for investor properties, you could pretty much bet that they're going to own a primary residence. And then that last sentence, that's not a big deal. Insurance must include 6 months of rent loss coverage. Not real 700 credit score. You can get in for a minimum credit score of 700. Now, this is important. First-time home buyers not allowed. You have to at least own a primary property for 12 months. So you have to at least own a primary for 12 months. Okay, so let's say you own that primary property, but you've never owned an investor property. So you own the primary, don't own the investor property. And that means it's not owned investor property for 12 months in the last 3 years, allowed with the following. So we talked about must own a primary residence, and then they're looking for that 1-to-1 ratio, meaning if your rental comps or whatever, 3,000, your PITI plus HOA fees cannot exceed 3,000. And there's a 30% down payment requirement. So once again, this is for a first-time investor home buyer. If they already own properties, this does not own investor properties, this does not apply. So bottom line, you own a principal residence with 30% down, you still have an opportunity to use this program without showing income, which is pretty cool. Okay, we'll either use rental comps or lease. That have the appraiser do rental comp analysis on a standard Fannie Mae or Freddie Mac form. We'll use that. Short-term rental income may be okay. Either get a 12-month statement from the current seller, or we rely on the appraiser to come up with the rental income. So really fairly flexible. And that's the calculation. That is a calculation. So, so basically a 1-to-1, unless you have 30% down, and then it's 0.80. And that, what I'd mentioned, so your PITIA, principal interest tax insurance and homeowners association equals 3,200. You have $4,000. Your gross rents are 4,000. You're still good. You take 80% of 4,000, and you're good at 3,200. So basically, we should be good there. So, so with 30% down, with 30% down, that's when we can use that 0.8 ratio, which puts less pressure on your principal, interest, taxes, and insurance. Puts less pressure. So if you have 3,200, to be clear, if you have $4,000 for your PITIA, you only need 3,200. You would only need 3,200 for the rent. So basically, or income, I'm sorry, you only need 3,200 in income. So 80% of the $4,000. Now, this is what's different from the Fannie Freddie. This is what is different. For these programs, when they do ask the borrower to commit for business purposes only, there's literally, and there's a deed of trust, of course, that is signed at settlement, but there's an occupancy affidavit that is signed, and it is pretty, like I'd say, it's very clear, and they want all our borrowers to sign it, indicating that you're only going to use that property for business purposes, meaning investor, that effectively that you will not occupy the property as a primary residence for effectively the life of the loan. That's, basically that's what you would be signing. So they are clear, and that's Fannie Freddie, when you go to settlement of Fannie Freddie, you're indicating that you're going to keep it as an investor property for 1 year. Effectively, that's it. On this type of loan, it's truly business purposes. So just an FYI for you or your clients, they will have to sign that affidavit at settlement. Or obviously, if we were doing the loan, we would send it to them before settlement. Are you comfortable with it? Because it is, once again, for business purposes only. And other arm's length transaction, 25% down, just like on a Fannie Freddie investor property. If you put 20% down, you're practically priced out. If you put 25% down, a lot better rate. That's the same with this program. 25% down, you're going to get what I would say would be a tolerable rate. And we'll go over these rates shortly. We will go over the rates shortly. So it does work better. $80% to $1 million loan amounts. If we're putting less pressure on the on your PITI, if we're putting that 0.8 ratio, so we're putting less pressure on the PITI. Literally, you put 30% down to $1 million. Now, this was as of yesterday's prices. And it looks like the market is fairly stable today. But considering, one, it's an investor loan. Two, there's literally no income, meaning no tax returns required, no W-2s required, no tax transcripts will be ordered. On the loan application, no employment. Literally, that's left out. So it's all about the subject property and the income that can be generated from the subject property versus your housing payment on the property. So considering, one, it's an investor loan, two, it's a true no income loan, 7 5/8 point 1/4, not, in my opinion, that's pretty aggressive. If we were doing a Fannie Freddie today with 25% down, probably in that same range, probably about 7 1/8, 7 1/4. So better on a Fannie Freddie, but it's not a no income. So this, and there's a fair amount of people out there. You know better than me, because I'm not out there, you are. But I would say there's a fair amount of people out there that are self-employed, that may own an investor property, but they just cannot prove or show their income. But want to buy an investor property and have the 25% down to get the better rate. We can go 20% down, about 1/4 to 3/8% higher with 20% down. So they'd be somewhere closer to, say, 8% at a point today. Still not horrible with 20% down. But that's where I think the opportunities are for those investors, especially self-employed people, or even even W-2 income that are, they may own 2 properties, and you see what we see, right? Not regularly, but a fair amount. We'll have a borrower that comes in that owns 2 properties, wants to buy another property, and on their Schedule E's, they're taking big losses. That's Schedule E as in Edward on a 1040 that shows rental income versus rental losses. So they're showing big losses. So sometimes it gets a little complicated when they already own investor properties. So this is where this also could work. You have an investor that owns 2 or 3 properties. On their Schedule E's, they're taking big losses, which is going to hurt. It's a negative, or it's considered a negative when you're doing a Fannie Freddie loan like debt, considered a monthly debt. This could be a way for them to buy either that second investor, maybe that third investor property. So something to think about. And who knows, that could open up some avenues for you as the realtor if you get that word out. Tell me this, we've got a handful of people that have joined us. Has anybody used a program like this yet for investor? Anybody? I see Mohammed, Gilma, Maggie, Sherry, Suhal. So it sounds like nobody has used it before. Okay. Well, just in general, I'm curious. See, it sounds good to me. And I think it sounded pretty good to Cindy when we were talking about it, when I was discussing it with Cindy. But why doesn't somebody chime in and tell me what you think? Like, do you think it's a good program that can open up some doors? I guess that's my question. Does anybody have any comment on that? Okay, quiet audience today. Okay, that's okay. That's okay. But anyway, hopefully this will help in some fashion. This program will help. Okay, this next program is also a very good program. The first program, that was, quite frankly, our true no income program, that investor program. That was our true, excuse me, true no income program. This is a darn good program. This is literally, literally where your borrower, if they have strong assets, they don't have to use the asset for the down payment, but they could use the asset as income. Uh, uh, so basically, do not have to use the income for the asset for the down payment, but they could use it as income. So let's take a look at this. So, and the important point is creating an income stream. So we're literally creating an income stream from your client's asset. What's also neat about this program is that it can be used with other sources of income or independently calculated. So you can use it with other sources of income. And here's a relatively simple example. Let's just say, now this is after settlement. This has nothing, you can't use what you've put in for a down payment and closing cost, but after down payment and closing cost, let's say example one, your client has $840,000 net eligible assets. You divide that by 84 months only. So in this case, you have $10,000 a month to use as income for that $840,000. Let's just say your example two, they have 400,000 net eligible after the down payment and closing cost. Divided by 84 months, 4761. Now, you might say, well, what's 4761 going to get my client? Let's say they're earning some Social Security or pension, or let's just say they earning not a whole lot of income. Say they're making another 50, 60,000 doing something else. You can use that income to add to, so in addition, you can use it. So like I see this as possibly opening up some doors. We do see, it's not huge, but we do I see people coming in with, and once again, getting back to self-employed, where they tend to have a lot of assets, but don't show a lot of income. So this asset depletion program may be a good program for them. Maybe a good program for them. And let's go to this next slide, to slide 12. And see, this is the neat part of it. Very generous in allowing deposits that can be used to qualify. Assets that can be used to qualify. Very generous. And when I say very generous, meaning, for instance, there's Fannie Mae has an asset depletion program. But this is what, first of all, they want 30% down. Okay, so you have to have 30% down. Secondly, they'll only use rollover IRA accounts. Rollover IRA accounts. And then you use a percent of that, like depending upon age or whatever, but literally your max that you can get out of it Like if they're in a stock fund, it's like 70%. Okay, 70 to 80%. So basically, that same person, we just used, let's just go back to this 840,000. Let's go back to the 400,000 example. That's easier. If this is a Fannie Mae loan, 30% down, okay. And let's just presume that that 400,000 is in a rollover IRA account only. So they won't use savings, they won't use checking, they won't use mutual funds. So they would take, say, 70% of that 400,000, 280,000. And do they divide it by 84 months? Fannie, no, divided by 360 months. So before you're done, you practically have no income. So after like looking at the guidelines for a typical Fannie Mae loan, dividing it by 84 months looks pretty darn good. And no comparison eligible assets. So they'll allow you to use checking, savings, certificates of deposits, money markets, 100% of those. And that should say publicly traded, marketable securities, 80% of those. Retirement accounts, anywhere from 80 to 100, depending upon age. Even cryptocurrency, which even though, look at that. So this is a pretty darn, see, the programs that we've just talked about, in my opinion, in a market like this is quite frankly, as I see it, could open up some doors. I think it can open up some doors for us as a lender. And the only way the doors open up for us as a lender, if they truly open up the doors for you as realtors. Because if it doesn't open up the door for you as realtors, because in like 99% of our business, quite frankly, comes from realtor referrals. If it doesn't open up the door for you, it's certainly not going to open up the door for us, for lenders. But I do I like it maybe because one of the reasons I've seen this Fannie Mae asset depletion account and struggle with only use IRA accounts, only use 1% of that, and then divided by the term of the loan. So if it's a 30-year loan, you have to divide it by 360 months. Seeing this is like, whoa, it's enlightening. It's like the light bulb, because very, very flexible program. Okay, it's not a perfect program. Ineligible assets, gift funds, business assets, cash value of life insurance. That's just a guideline. Stock options, no. Foreign assets, no. So there are some ineligible assets. Okay, additional requirements we would be asking, instead of standard fare on these Fannie Freddie loans, we ask for 2 months of bank statements. Occasionally on a Freddie loan, it'll be 1 month. They're a little more liberal than Fannie Mae. And we mentioned this before, assets used for down payment, closing cost, and reserves must be excluded. And that's common sense. Okay, this last sentence, all individuals on the accounts that we're using must be a borrower on the loan. So if it's a joint account, must be a borrower on the loan. And pretty generous. 85% to $1 million, and that's with no MI. 80% to $2 million. Minimum credit score 700, maximum debt to income ratio 50. And now what I did is just to show you with 20% down at the very bottom. So with 20% down and a 740 credit score, these were actually yesterday's rates because I didn't have time to, like, rates normally come out, sometime in the next, like, as we're speaking. So these were, and the market really hasn't moved much today. Let's see. Let's see what we have. Yeah, the market's fairly flat today, so we really shouldn't have any changes from yesterday. Okay, so basically today, now these are also, I should say, 30-day quotes. Okay, put 20% down on this asset depletion program with a 740 credit score. You can get 7.5% rate at no points, 7.25 at one point. Now, like, considering its asset depletion, like, I think that's like, I would say it's tolerable. I mean, obviously, it's not a Fannie Freddie rate today. With a 740 credit score and, say, a non-first-time home buyer, you're probably pretty close to 6.5 at zero. Probably pretty close to 6 1/8, 1.25, somewhere around 6 1/8. So Fannie Freddies are getting regular loan amounts up to 766,550. We're talking about the lower sixes now rather than the upper sixes. So, but can't use the asset depletion. And see, the whole point of this conversation today, the whole point of it is opening up new doors, selfishly speaking, obviously for us, but also for you. And I believe these first two programs are door openers, may trigger some ideas for some new business for you. Hopefully that's the case. Hopefully that's the case. But any questions on that asset depletion? I think the 84 months what makes it, and the fact that it's a decent price, pretty darn decent rates. I think that makes it very attractive, very attractive. Okay, let's see. Now, this bank statement program is for self-employed people only. So bank statement program for self-employed only. So it's designed for borrowers with an active US-based business that is generating stable revenue. Now, these bank statement programs, like these, the first two programs that we went over, cut and dry, very simple program, very easy to follow. But on now also just, and I'm sure your favorite lender will do and have some of these same programs. But our company, like each of these programs that we're reviewing today, our company processes, underwrites, closes the loan. So in our name. Now, quite frankly, these, like our company, we are a servicer. So our Fannie, Freddie, VA, FHAs, we pretty much service those loans, meaning we close the loan, our borrowers will make the payments to us, to New American Funding. These type of loans, we do the standard fair thing, which most mortgage bankers do. We underwrite it, we process, underwrite it, close in our name, and then 30 days later, we sell to the investor, but we control it. And the name of the game is control. We do not broker these loans out. So we have full control over our destiny. And I would say your good, strong lenders that you use, I mean, they're, like they also understand you have to control your destiny. And quite frankly, sometimes it's, controlling your destiny, it's still, you have to be very focused even when you control your destiny. So basically, bottom line, the three programs that we're presenting, we process, underwrite, flows in our name. So full control. That's
Dave, we have a question in the
sure.
chat.
Go ahead.
What rates apply to loans with down payments of 25% or 30%? That is,
Okay.
I guess she wants to know, Gilma wants to know today's, because tomorrow's rates may be different.
Yeah. Generally speaking, if we're not talking, like generally speaking, if we're talking about these programs, like generally speaking, the 25% down will be just slightly better than 20% down on these programs. Maybe 1/8% to 1/4% max. On a Fannie Freddie program, about 1/4 point total between a 20% down and a 25% down. But on these programs, you get a slight you get a slight improvement, but it's not like it's just slight, like 1/8 to 1/4 total percent, 1/8 to 1/4, but better than nothing. Or you get lower points. But there is a good question, because once you get to 25% down on many programs, the only programs where there's really no difference that we work with is these first-time homebuyer programs for Fannie Mae, Freddie Mac, where regardless of you could put 3% down, you could put 25% down, same rate. And also, not getting off topic, but on these first-time homebuyer programs with Fannie, Freddie, you could have a 700 credit score, a 680 credit score, or a 780 credit score. The rate will not change on a first-time home buyer. They're called home ready, home possible. Just some food for thought. Where you get hurt on programs like that is the PMI companies. When you're putting 3-5% down, if you have a low credit score, you're going to pay a lot for the PMI. But a good question, 25% down, there will be an improvement. 30% down, there will be an improvement. Okay. Bank statement program, to finish this up, must have been self-employed in the same business for the last 2 years. A minimum of 25% ownership. These work best, quite frankly, when there's 100% ownership. That's where they work best, because that's when you can use the most income. So 100%, like you can participate in the program at 25%, but it's going to be hard to sparse out income with only 25% ownership. And they're looking for business, to get a feel for the operations of the business. Now, the primary purpose of provide a signed written business narrative is so we, the lender, could determine a fixed expense ratio. Like, what are we going to use for a fixed expense? Are you going to use 20% of the eligible deposits? Or are you going to use 40%, 30%, 50%? This will help. Like, standard fare, if it's like a one person, self-employed, no employees, you can count on less than 50%, maybe as low as 20%. Like, the less complicated, the less expenses. The more complicated, the more expenses. So that business narrative is important. And that number of full-time employees, that's important. The more employees, the higher the expense percent will be. Okay, so this bank program, you could do a 12 or a 24-month bank statement. Obviously, 12 would be less complicated. And these are consecutive bank statements within 60 days of the note date. So when we suggest multiple accounts allowed, meaning if you have business activity on a personal account, that could still be okay. Ineligible deposits, tax refund, loan proceeds, any non-business related deposit. And then as a rule of thumb, just as a ballpark, we would use 50%. Like we said, these like 100% owner, no employees in a type of business that requires no major expenses. It could be as low as 20% of eligible expenses. This is what I would suggest when you're using programs like this, or quite frankly, any program. I think you already know this, but especially programs like this, I would darn dig into it with your lender. Like what we do, because a little bit out of the box. Okay, it is a little out of the box. So what we would do is literally take in all the information, submit it for a pre-approval. Okay, look at it, our underwriters look at it, so there's no equivocation. Yes or no, like, or not necessarily yes or no, how much can we use in income? Especially for this, I'd say the bank statement program, a lot more important to do that than the other two. The other two are not complicated, especially the debt service coverage ratio. That is not complicated. A lot of that, you as a realtor could do rental comps, figure it out before you send them in. Now, we, of course, will do the rental comps, or if you have a lease. So the debt service coverage ratio, that investor buying an investor, it's really pretty simple loan because there's not much to gather. The asset depletion, a little more to gather, especially if we're using one's income and one's assets, but still pretty cut and dry. Bank statement program, more complicated because of the business expense factor and the type of business. And the fact that you're getting 12 bank statements and all those transactions, we're nitpicking. So the bank statement program is a little more, that's the program that I would, quite frankly, dig into more than the other two. The other two are pretty cut and dry. So, now to finish up this bank statement program, 85% to $1 million with no MI, 80% to $2 million. Credit score minimum 700. Now, I just picked a 740 credit score. And the reason you might ask, well, why would you do 740 credit score? Because if we had to, in this course, we can do lower credit scores for higher rates because we see that minimum 700. But I would say in this area, 740 is that's we see, quite frankly, 740 and up. That's what I'd say. Most of the cases that we get, I think we're just lucky to be in an area where people have good jobs, able to pay their bills on time, and their credit is important to them. Now, we also, believe me, we have, we do government loans with credit scores, like we can do we'll be in the 500s, 580, 600 government loans. So, there's a place, there's a place for a heck of a lot of borrowers in today's lending industry. And plus lenders just like us, we'll get a low credit score, and then the whole focus is on, okay, how are we going to, let's figure out a way to raise that credit score to make our borrower eligible. Okay, you have a 590 credit score, have some things on the credit. Let's see if we can get them an authorized borrower, 2 or 3 accounts from a parent, And then in 3 or 4 weeks, that score goes up, you have a better shot of getting an FHA loan. So basically, and your lenders will do like us, like, I think we've been forced to be more creative, quite frankly, to try harder. But, bottom line, that's really been my focus since I've been in the business. I want to try to figure out and be of support, help to our borrowers, and be of support and help to the agents that I work with. That's really, how I see life in our business. So at any rate, I'm available by phone call. I did throw out a lot in a short period of time. I do like that debt service coverage ratio program because it's simple. Asset depletion, simple. And they're both fairly well priced. And like I said before, not to keep repeating myself, this is where I believe there may be some opportunities that will open some doors for new business for you, the realtor. But you know better than me. So I'm good. We're good. If you do have any questions, you could email me, call me. Like if evenings are fine, weekends are fine. If I'm around, I'll pick up the phone. So this is why after hours, weekends, if I'm most likely, if you call me, I'm going to pick up the phone. That's the least, quite frankly, that I could do. If somebody's going to be good enough to give me a call, I certainly should pick up the phone regardless of the time of the day or the day of the week.
So you're going to send the slide deck later so they have your contact information.
Yeah.
Also, guys, there are a couple of you that were really late. I'm going to do, I don't generally send out the link, but I'm going to put it on Dave's instructor page. So if you go to, I don't have it yet. This is a live thing, so I've got to render it, but a couple hours, it'll be at cindybishopworldwide.com to upcoming events. You go down to the right, it says meet our instructors. And then you click on that and go over and click on Dave's picture and you go and you'll find it there so you can rewatch it. I think this is probably, in my opinion, being a kind of flexible lending kind of mindset agent, this is like the most important webinar that you have access to, because it offers so many opportunities that nobody knows about. Like nobody, okay? And plus a lot of companies don't even offer this stuff. There's a program in here I'm probably going to use if I ever find a house I want, because it's perfect. I have a lot of assets and it's just perfect for me. So anyway, all right, well, we need to run, but thanks, Dave. I'm going to send you the roster so you can send out the slide deck. Thanks, guys.
Have a great day.